The stock market can seem like a complicated maze. It's not something typically taught in school. Many people find it intimidating. But the truth is, anyone can learn to invest. You don't need to be a financial expert. You don't need a huge amount of money. Investing in the stock market is accessible to everyone. It's a way to grow your wealth over time. Think of it like this. You don't need to be a mechanic to drive a car. You just need to understand the basics. This essay will guide you through the fundamentals of the stock market. Let's break down the jargon and make investing less mysterious. We'll empower you to take control of your financial future. Imagine you want to start a lemonade stand. You need money to buy lemons, sugar, and a stand. To get the money, you can sell shares of your lemonade stand. Each share represents a small piece of ownership in your business. The people who buy your shares become part owners. This is similar to how companies raise money on the stock market. Companies sell shares to the public to fund their operations. This could be to expand their business, develop new products, or hire more employees. When you buy a share of a company's stock, you own a tiny piece of that company. Stock refers to the overall ownership of the company. A share is a single unit of that ownership. It's like a slice of a pie. The price of a stock is constantly changing, reflecting the dynamic nature of the market. It goes up and down like a dance, a complex choreography of numbers and trends. The main factors driving these price movements are supply and demand, the fundamental forces of the market. Supply is how much of a stock is available for sale at any given time. It's like the inventory of a store. Demand, on the other hand, is how many people want to buy that stock. It's the level of interest or desire for the stock. If more people want to buy a stock, high demand, then sell it, low supply, the price goes up. This is because buyers are willing to pay more to acquire the stock. Think of it like a popular toy during the holiday season. If everyone wants it, the price will likely increase due to the high demand and limited supply. Conversely, if fewer people want to buy a stock, low demand, and more people want to sell it, high supply, the price goes down. Sellers might lower their prices to attract buyers. News and events can significantly impact supply and demand. Market sentiment can shift rapidly based on the latest headlines. Positive news, such as strong earnings reports or exciting product launches, can increase demand and drive the stock price up. Investors become more optimistic about the company's future. For example, when Tesla announces a new electric car with impressive features, demand for Tesla stock often surges. Investors anticipate higher future profits. On the other hand, negative news, like scandals or economic downturns, can decrease demand and cause the stock price to fall. Fear and uncertainty drive investors to sell. Remember the dot-com bubble? Hype inflated stock prices, but when the hype faded, prices crashed. It was a stark reminder of how quickly market sentiment can change. Understanding supply and demand helps investors make informed decisions. It's the key to navigating the stock market's ups and downs. Stock exchanges are marketplaces where stocks are bought and sold. These exchanges provide a platform for buyers and sellers to come together and trade shares of publicly listed companies. They play a crucial role in the financial ecosystem by ensuring liquidity and transparency in the trading process. Some of the most well-known exchanges are the New York Stock Exchange, NYSE, and NASDAQ, and the London Stock Exchange. Each of these exchanges has its own unique characteristics and listing requirements, attracting different types of companies and investors from around the world. In the past, trading took place on physical trading floors. Traders would gather in large rooms, shouting and signaling to buy and sell stocks. This method, known as open outcry, was the standard for many years before the advent of electronic trading. Now most trading happens online through brokerage platforms. These platforms have revolutionized the way we trade, making it more accessible and efficient for individual investors to participate in the stock market from anywhere in the world. These platforms act as intermediaries, connecting buyers and sellers of stocks. They provide the necessary tools and resources for investors to make informed decisions, including real-time data, research reports, and analytical tools. To buy stocks, you'll need to open an account with an online brokerage. This process typically involves providing some personal information, verifying your identity, and funding your account with an initial deposit. Popular options include Robinhood, Webull, and Trading 212. Each of these platforms offers different features, fee structures, and user experiences, so it's important to choose one that aligns with your trading style and goals. but be sure to research and compare different platforms to find the one that best suits your needs. Look for factors such as commission fees, ease of use, available research tools, and customer support. Once you've opened and funded your account, you can search for the stock you want to buy using its ticker symbol, which is a unique code representing the company. This code helps you quickly locate the stock on the trading platform. You can then view the stock's price chart, choose the number of shares you want to purchase, and place your order. It's important to review the stock's historical performance and current market conditions before making a decision. You can place a market order to buy the stock at the current market price. This type of order is executed immediately at the best available price, or a limit order to specify the maximum price you're willing to pay. This order will only be executed if the stock's price reaches your specified limit, giving you more control over the purchase price. Section 5. Strategies for success, long-term versus short-term. There are various investment strategies, each with its own level of risk and potential reward. Day trading involves buying and selling stocks within a single day, aiming to profit from small price fluctuations. While potentially lucrative, day trading is extremely risky and not recommended for beginners. Statistics show that around 80% of day traders quit within their first 2 years. Long-term investing, on the other hand, involves holding stocks for extended periods, often years or even decades. Legendary investor Warren Buffett is a proponent of this strategy. He believes in researching and investing in undervalued companies with long-term growth potential. However, in-depth company analysis can be challenging for individual investors. It requires time, knowledge, and effort. Section 6. Index funds. Your ticket to diversification. Index funds offer a more passive approach to investing, suitable for both beginners and experienced investors. An index fund is a type of mutual fund or exchange-traded fund, often referred to as an ETF, that tracks a specific market index, such as the S&P 500 or the FTSE 250. Investing in index funds is like buying a small piece of the entire market. Instead of trying to pick individual winning stocks, you're investing in a diversified basket of companies, reducing your risk. Index funds historically provide relatively stable returns, averaging around 6 to 10% annually. This is significantly higher than traditional savings accounts, making index funds a powerful tool for building long-term wealth through the power of compounding. Section 7. Before you begin, essential considerations. Before you start investing, there are crucial factors to consider. These considerations can make the difference between a successful investment journey and a stressful one. First and foremost, manage your emotions. Investing can be an emotional roller coaster, and it's essential to stay calm and collected. Don't let fear or greed dictate your decisions. These emotions can lead to impulsive actions that may not align with your long-term goals. Avoid impulsive actions driven by the fear of missing out, often called FOMO, or panic selling during market dips. These reactions can lead to significant financial losses. Secondly, ensure you have a solid financial foundation. This means having a clear understanding of your financial situation and goals. Before investing any money, build an emergency fund that covers 3 to 6 months of living expenses. This fund is crucial for financial stability. This fund acts as a safety net in case of unexpected events, preventing you from having to sell your investments at a loss. Be wary of scams. Scammers often prey on new investors. If something sounds too good to be true, it probably is. Always do your research and verify the legitimacy of any investment opportunity. Be skeptical of anyone promising guaranteed returns. No legitimate investment can guarantee profits without any risk. Legitimate investments always carry some level of risk. Diversification is key. By spreading your investments, you can protect yourself from significant losses. Don't put all your eggs in one basket. Diversify your portfolio to include a mix of stocks, bonds, and other assets. Spread your investments across different companies, industries, and asset classes to minimize risk. Finally, consider dollar cost averaging. This strategy can help you manage market volatility. Instead of investing a large sum of money all at once, spread it out over time. This approach can help you avoid the pitfalls of market timing. This strategy reduces the impact of market fluctuations and helps you buy more shares when prices are low and fewer shares when prices are high. By following these essential considerations, you can set yourself up for a more secure and successful investment journey. Section 8. Navigating the market with confidence. Remember, investing in the stock market involves risk. The value of your investments can go down as well as up. Never invest more than you can afford to lose. It's a journey, not a race. Focus on long-term growth and ride out the inevitable market fluctuations. Don't be afraid to seek help if needed. There are numerous resources available, including financial advisors, online courses, and educational materials. Start small, learn as you go, and enjoy the process of building your financial future. Section 9. Conclusion. Embark on your investment journey. Congratulations! You've taken the first step towards understanding the stock market. Remember, investing is a marathon, not a sprint. It's about making informed decisions, staying disciplined, and focusing on the long term. Continue to learn and explore the vast world of investing. There's always something new to discover. Start small, stay informed, and never stop growing your knowledge. You've got this. Thanks for watching and subscribe to our channel for more videos to profit.